Hey everyone, welcome back to Corporate Decoder, the place where we dig through company filings so you don't have to. Today we are diving into the fascinating world of money market funds. Don't click away just yet, because hidden in this report is a story about how even the safest investments can reveal how companies really make their money. Think of it as peeking behind the curtain of supposedly boring finance. The big picture summary is this. We are looking at HSBC Fund's report from April 2025. These are semi-annual reports, kind of like a checkup in the middle of the year, and what's crucial as the company is taking some pretty safe and standard moves and investments. This filing also gives some info as to risks, so it's really not that boring in the end. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Check it out. So this document is a Form N-CSRS, which in plain English is a certified shareholder report for registered management investment companies. Basically, it's a report card that these funds have to show their investors every 6 months, and it includes those semi-annual shareholder reports. These reports give you all the important information about the HSBC US Government Money Market Fund for a period of about 6 months from November until April. Because this is for multiple funds, they are comparing costs. But before we get there, all of these funds have costs. Something to keep in mind is that this is based on a hypothetical value of $10,000. For example, the Class A type is going to cost $24, about 0.48%. In comparison, Class I is only going to cost $7. For key fund statistics, we have total net assets, which are about $42 billion. The net advisory fees paid are $16 million. Now, taking a look at where the fund invested, we will see a percentage. Repurchase agreements were about 44%, US government obligations 25%, US Treasury 24%, then a minor amount to investment companies at about 5%. Sure, these numbers may not be true later. Keep this information in mind. There's a similar report here for the HSBC US Treasury Money Market Fund. It contains the same type of information, so let's focus on the distinctions. Here, the Class A cost is $25. For Class I is $7. Total net assets are substantially less at $5 billion. Net advisory fees paid were $1.2 million. As you can see, it's a huge difference in total assets to the prior fund. Here, the investment allocations are much simpler. All of the fund goes into US Treasury obligations 100%. Here's the schedule for US Government Money Market Fund. Federal Farm Credit Banks, for instance, contains a few different values, with most being close to 4.5%. Most obligations happen in 2026. A lot of the values, such as the federal home loans, are around 4.3%, although this value is adjusted based on something called SOFR, which you can think of like some benchmark interest rate. US Treasury notes are interesting, as some are much lower, such as 0.38%, but mature in 2026. Repurchase agreements are at 4.38%. The investment companies are all 4.2%. Then here is the schedule of a Treasury Money Market Fund. Many of the Treasury bills are at around 4.3%. Most of these are due in October or so. Take note of the USB MI3M value as well. Here we have a comparison of assets and liabilities. If you remember, the Government Money Market Fund was around $42 billion in assets, while the other market fund was around $5 billion. A big difference that will affect a few different numbers. And as you can see in the statements of operations, this is present. For the money market fund, it's $834 million in income compared to only $120 million income for the other fund. Expenses is about $19 million for one and $2.6 million for the other. This is for investment management fees. These financials highlight some selected data. For Class A shares, net asset value at the beginning of the period comes in at $1. Then from investment activities, you increase that dollar by 2 cents. Then you lose those 2 cents in distributions. There's an important note in the document that states total return calculations do not include any sales or redemption charges. A very important thing to note. Again, with US Treasury, we see very much the same information, just with different numbers, but there is an important change. I always like to see this section because it has to do with internal controls. Basically, these are procedures within a company that make sure the numbers presented are credible and correct. Here, the big bosses are saying that, yep, the internal procedures seem effective. The top dog, Stefano President, is signing off on this, saying all is good to Tevdal. Let's step back and think about what this filing really tells us. Money market funds are designed to be safe, so big swings in value aren't expected or frankly desired. Everything looks pretty standard. What does that mean? The US Government Money Market Fund is a safe bet, but with more risk and ultimately more reward. It's a mix of different bonds, but that mix is more prone to getting affected by outside forces. The US Treasury is much less, but really safe. This is more of a savings fund, as really those 4% returns are something. What about risks? If interest rates rise from other banks or investments, that becomes real problems. The solution is that they will simply have to increase interest or provide something to attract users, since these investments are for stability, not hypergrowth. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.